Welcome, everyone, to this edition of the Market Signals podcast. It is Tuesday, December 6th. My name is Marc Zabicki, Chief Investment Officer at LPL Financial. Joining me is our Chief Economist, Jeffrey Roach. Jeff, how are you today?
Hey, doing well. Glad to be back on set with you.
Well,
in a
yeah,
few weeks.
I appreciate it. You've been busy this year. Certainly busy over the last few days in the market. Given the Powell speech last week, given the non-farm payrolls numbers on Friday, we're going to get into a little bit about that. Always good to be with you, Dr. Roach. Before we do kind of dip our toe into some of what happened last week and some of the things that we are keying some of our conversations and our asset allocation committee meetings. Want to talk a little bit about what has happened over the last 5 trading days. The market in general terms in the U.S. has been, buoyant. Most of this has come from the gains that we saw on Wednesday based on Powell's speech at the Brookings Institute. And other areas of the marketplace in terms of non-U.S. markets, a little bit more problematic, although some semblance of positive activity continues to happen in Europe. So call it global equity markets have been, mixed over the last 5 days. U.S. markets have been the strongest area in general terms. Fixed income, still considerable amount of tailwind in fixed income as of the last, several weeks or so. That markets begin to clean itself up now that we're having additional levels of visibility into what Fed policy may in fact look like. Commodity markets still pressured to the downside, even though the dollar has kind of come off its highs. You would think it would add, some semblance of sustainability to the commodity market, but we haven't really sustainably seen that yet. And last week, Dr. Roach, it was 2 key elements to, which is to our conversations as an asset allocation committee, which it seemingly in 2022, it's been all about, inflation and the Federal Reserve, et cetera, et cetera. Fed Chair Powell certainly had, some good elements for the market to digest on Wednesday, and then the non-farm payrolls number on Friday and the entire jobs report. Just quickly, your assessment on the Powell speech and the payrolls report.
Yeah, so good question. So I'll take those 2 bullet points together because I think in conjunction, it paints a really interesting story. So midweek, Powell spoke at the Brookings Institute, and I actually went through and counted the word balance. Actually shows up 5 times in his speech. And the reason why, of course, I have incentive to count that word, because as you know, Marc, today here, December 6th, we're actually releasing our 2023 outlook, which references finding balance, because it's such an interesting time when you think about labor markets, hence the second bullet point, think about payrolls, but you think about labor, think about supply chains, think about housing. We'll actually talk about that in a little bit. So much of this can actually be brought back to, the age-old supply and demand curves. And when they intersect, we're at equilibrium. The market is balancing out the supply and the demand. And right now, in so many sectors of the economy, it's all about this balance and an imbalance between those 2 components of supply and demand. So markets rallied off of Powell's speech because he was hinting at the fact that inflation truly is past peak, and the Fed can legitimately slow down the pace of rate hikes. And then 2 days later, the markets were quite frustrated with this job market that seemed to be still very tight and somewhat hot in terms of a tight labor market pushing up wages. So we'll talk more about that later on in the podcast today, Marc. But those are the first two, and in essence, kind of a bull bear right there, back to back within 48 hours.
Yeah, and it's interesting, Powell's commentary on Wednesday, and basically the admission that inflation is past peak, and the Federal Reserve is now going to kind of gear down in its tightening cycle, which effectively are two expectations that we've long talked about in our asset allocation committee, and one of the reasons why we remain constructive on risky asset prices, equities in general, because we thought the market just kind of had gotten it overdone in terms of the fear around Fed policy, the fear around inflation, when we've been talking about, well, inflation's already starting to ebb, even though not too many people are really talking about it. And yes, the Federal Reserve is going to stop raising rates at some point, and we thought that was going to be a little bit less of a headwind, maybe more of a tailwind. Is that fair?
Yeah, that's right. In fact, internally, we've talked about this. I've highlighted the industry data that shows that even the sticky components of inflation, such as rents, have declined across the country. So in aggregate, 3 consecutive months, as we sit here today in December, we have 3 consecutive months of declines. That's certainly adding to that narrative that we're past peak, both in the goods component, which has been more obvious. And in fact, in previous market signals, Marc, I think you and I've talked about this, but I've showed that graph where, goods prices have just completely plummeted, and you had that services component naggingly elevated. Well, we're finally at that point where we're starting to see that turn over as well.
Yeah. And just to round out this slide for the audience, I mean, the China equities is kind of an interesting market, over the last couple weeks or so, because we're getting that reopening expectation from China, and that's added a little bit of a tailwind to Chinese equities. Is a little bit of a tailwind in general terms to emerging markets, although that's probably a halting tailwind as far as we're concerned. I don't know that this is a sustainable trend for us in terms of our asset allocation work, meaning that we're still underweight emerging markets. And while the reopening expectations out of China is certainly good news for that market and also for the global economy, I don't know that it's going to translate into our change of view in emerging markets. But we'll continue to kind of keep an eye on that. 10-year Treasury yield down to 3.5% last week, and seems to be bouncing off that point of resistance. So we'll see how things transpire in that market. But kind of a key inflection point we're looking at in terms of the 10-year Treasury. Looking ahead to this week's numbers for economic data out of the U.S. Turning to you, Jeff, on the PMI numbers yesterday, and any comments that you've got in terms of what to look forward to this week in U.S. economic data.
Yeah, so in terms of the PMI services, we got that yesterday. Actually shared some of this with our colleagues as well as media outlets. So the story continues that prices paid is declining. I think the big takeaway for me is the fact that export orders, new orders for international demand, has really plummeted, meaning that when you compare the domestic economy to the international economy, you definitely, on a risk-adjusted basis, you see, all right, a much lower risk domestically. So very low demand internationally. You saw that in the services component. Later on in the week, I'm going to focus on the unit labor costs on Wednesday. With the inflation story we just referenced in the previous slide about goods prices and services prices, rents prices, the overall concern, the big picture is if labor markets remain tight, wages have upward pressure, that gets passed along to the firm with their labor cost being a larger percentage of total costs. And so unit labor cost is really important. This is a quarterly number, so it ends, September, so you don't get October data in this figure. But I think it's helpful from just a trend perspective. I'll be watching that as well as its corresponding component of productivity, right? So if you get labor costs at more expensive, but it's if offset by just people being more productive, in essence, that's a pretty good trade-off. So you need to really keep those things together, labor costs and productivity. And then, of course, at the tail end of the week, you got another component of the pipeline of inflation. So PPI is producer prices, and producer prices help us think about what's happening in the pipeline before it gets to the consumer. What is the firm getting hit with in terms of input costs? And then, of course, University of Michigan, thinking about, another component that rounds out the conference boards data. And so I think, overall, this week's going to help us with that overall theme that we're probably not in a recession right now. Here we are sitting beginning of December. We got some November data, but Q4 is probably not going to be the first quarter of a decline or a contraction. And so far, we kind of have a nice soft landing. So we get a lot of good insights this week, and it'll help us round out and continue the theme that I think is going to happen. And that is, 2023 is going to be a little more of an inflection point than 2022.
And since we've got the chief economist on set, let's take a look at this week of economic data outside of the U.S. What's catching your eye here in terms of things to pay attention to?
Yeah, I think look in the middle of the screen there. You're seeing Japan data for GDP. Japan is worth watching. Now, again, when you think from an allocation standpoint, an investment standpoint, it's risk adjusted. So, you might see, as you referenced earlier, Marc, about emerging markets looking more and more attractive. But again, that's relative to what we're seeing in the U.S. If risk appetite increases across the globe, you probably want to still think about staying domestic focused. But Japan, here we are. This year, 2022, was a year that inflation actually rose above 1%. And in fact, as we sit here now, inflation is over not just 2% year on year, over 3% year on year in Japan. That's historic, at least in the last several years. And so I think Japan's interesting. Obviously, the yen was a challenge for the Bank of Japan to kind of work through and manage with currency interventions. But if you think about growth, this is for Q3 on Wednesday, but the trajectory for Q4 growth, particularly when you start seeing household spending look pretty decent and business investment look pretty decent. Watch Japan, and Germany, China. All of these nations are in the top five. We tend to be U.S. focused. Maybe we have that home country bias, but I think it's really helpful to not just focus on the U.S. side, but think about the internationals as well. So Japan's at an inflection point.
And again, turning to you, Jeff, on this economic data, and I know you've gotten a question from media and other folks about what economic data is not falling off the table. Let's take U.S. as an example. It's actually maybe worrisome for the Federal Reserve in terms of the its view on inflation pressures, et cetera. So talk to us a little bit about this soft landing concept. And I don't know that we're bought into that, but it has been a point of conversation. And then obviously, you mentioned inflation expectations are ebbing, and we will get the PPI numbers, and then University of Michigan inflation expectations are also supposed to kind of ebb a little bit, which is perhaps comforting. What are your thoughts?
Yeah, I think we can really take this whole slide in one fell swoop and just take a step back, remind ourselves that the whole conversation about a soft landing just means that when you're coming out of a very hot part of the economic cycle, the Fed comes in and tightens financial conditions, kind of tightens up access to credit. So both consumer spending and business spending kind of pull back. This quote unquote soft landing is basically just a shorthand for us to say, hey, is it possible the soft landing in that ideal world is the economy cools, aggregate demand cools, and in essence, kind of pulls back inflation without necessarily pushing an economy over the brink into recession. That's a soft landing. Soft-ish, as coined by Chairman Powell, soft-ish is just saying, hey, well, maybe there's a little bit of time where we're actually contracting as an economy, but it's soft-ish because it's not a hard landing, something breaking, an economy falling into recession. So going back to the original question, Marc, as you're posing, looking at the data, we think, well, look, soft-ish, maybe we're not in, we're not kind of poised for that recession. I think you take it in the big picture and say, correct. So far, we're slowly decelerating, coming off a very hot kind of reopening, loose, easy money, crazy hot residential housing market, coming down to a more sustainable growth path. Now, all of that, it kind of ignores the housing market altogether because the housing market it's fair to say that's in recession, meaning it's coming back off of bubble-like levels. But in aggregate, as an economy, the economy is so far it looks like a softish landing. We're basically just saying the risks are rising for a 2023 event where consumers really have to pull back on spending. They don't have real wages, and they have to tap into credit and take some of their savings off the table and bring it to support their spending habits. So far, you're right. The data does suggest we're coming down in a softish path. And things look good. I think it's just going to change a little bit here as we go into the new year.
Yeah, and another aspect of what we clearly pay attention to is the dollar's level, and the dollar has rolled over, although it's bouncing against some support at 105, the dollar index. So something to keep an eye on, not only for U.S. investors, but also for investors who have allocations in emerging markets. So we'll see where the dollar goes, where if it bounces off that support or in fact breaks through. Some interesting concepts that you want to cover, Dr. Roach, in terms of the jobs report, housing market balance. So I'm just going to kind of turn microphone over to you about just your quick assessment of where we are in terms of some economic key points to pay attention to.
Yeah, great, Marc. And part of the point I think in this podcast is we show not just us talking, our talking heads, but we're showing graphs, because if listeners want to dive into a little bit more, they have the source data right there. They have the kind of the key takeaways from us, and they can go a little bit deeper if they want to. So in this case, and for this podcast, let me just give you just some high level takeaways, summary points for each of these. But I do have a couple of graphs that kind of give us a well-rounded view on the labor market, and then I'll touch on the housing market after that. So in this sense, I think it's fair to say that firms, particularly small businesses, are finding a little more ease in getting their labor demand and their mix of labor and capital with the overall environment, getting that mix right. You think about the oil and gas mix in our lawn equipment here, right? So here's kind of that mix. You think we've turned over from very high levels from those periods, say a few months ago, when firms were saying one of their most biggest concerns was finding qualified workers. That was amazingly high in the last few months. That has turned over. And so you can see in the graph here, there's a little bit of that loosening, still very tight, but a little bit of that loosening that we're seeing. So wanted to just put that in front of our readership. Go to the next slide. And really, it's in conjunction with this. You think about where we are in the labor market. And in essence, I think my bullet point kind of takeaway here is the labor market is still playing catch up with pre to post COVID, or you could say that firms are trying to, get back to more normal levels of employment. So you think about, a trend as we're looking for that efficient ratio of employment to population, right? How many people should be working? But in some ways, we want a little bit of slack in the labor market so people have the ability to kind of say, hey, this is not my highest and best use. I'll go over here. Or maybe I want to change careers. So there's this idea among investors and market watchers that there is this non-accelerating inflation rate of unemployment, and we want to have a little bit of that in the economy to create the slack. Right now, we're not, because we're still playing catch up. And here's the point here: total employment, based on trend and population growth, we're still about 4 million away from pre-pandemic trend. So yes, we've recovered a lot of the jobs in some sectors. We've not recovered probably, I think it's about roughly 900,000. So it's just shy of 1 million leisure and hospitality jobs have yet to be recovered. Highlighted that actually after last Friday's report. So we're still 4 million away from trend. That's going to keep the labor market a little bit tight, even if we fall into recession next year, even as the Fed kind of pulls back the access to credit and tightens financial conditions even farther. So there we are. Next slide. And that goes to what we talked about just a couple minutes ago. Mark, you were asking me, if you look at all the economic data, things still look like we're in this softish landing. And in fact, I shared this with you and our colleagues internally just yesterday. And I said, when you think about how the labor market has slowed, it hasn't been a dramatic, slowing where people are going from hiring to firing. We're just going from really fast rates of hiring to slower and slower and slower rates of hiring. And that's what this graph shows you. So, month to month changes in jobs, that's your column. The two line graphs are just smoothing out a little bit, 3-month average, 6-month average there on the orange line. And you couldn't ask for a better, softer Goldilocks scenario. And I think that illustrates, Mark, what you were just asking just a few moments ago. That illustrates a pretty decent slowdown. Now, one of the things that I've had, people question me, so, is this good news? Is this bad news? And I said, well, one of the key takeaways is some aspects of the job market take some time to actually illustrate what's happening in the real economy. So in the past several cycles, when housing slows, it's a good 3 to 5 months before construction jobs actually dry up. So I think it's fair to say, we have some more softening. I think it's fair to say, we'll be below, 100,000 jobs month on month on average after, construction jobs start slowing down. But what's keeping this up is the catch up. As I referenced in the previous slide, you still got 1 million jobs in leisure hospitality, roughly, yet to be brought in. So there you are. Go ahead. Yeah, Mark, you got a question?
I was just going to say, I mean, you contrast this, kind of Goldilocks-ish or soft-ish landing that we've seen so far. You contrast that with, some of the expectations that were built into market prices over the last, you call it 6 months or so, where people were expecting to see something, the Fed break something, right? And then so consequently, there's a lot of pessimism built up in September, pessimism built up in May and June, and then but we really haven't seen that yet, which is interesting, and one of the reasons why we've gotten a little bit of a market reprieve in terms of equities recently. Is that fair?
Yeah, I think so, because I think it really depends on who you ask when you think about the optimism or pessimism of the economy, because we do have the tale of two economies, as I've said recently in a piece where I was writing. So, if you ask someone that's household income in the upper level, what they're going to be a lot more optimistic than those in the lower incomes, and that's because inflation impacts the lower income households much harder, much deeper. So it's the tale of two economies. It's the upper incomes, it's the lower incomes, and they're going to feel very, very different. But you're right. In the aggregate, we're not seeing a dramatic sell-off. Here's something I wanted to highlight in terms of some labor market tightness. I referenced this before, but the job openings and labor turnover support survey, the JOLTS report, was really kind of a boring report until Chairman Powell brought it up several months ago. But what this gives us is it gives us a insight into labor market churn. I like to use that phrase. It's kind of this churn. Okay, people, coming and going, quitting here, going over here. The churning is what's really helpful, because it helps us understand, what the economy is feeling. So the dark blue line is that openings to unemployed. That's the ratio that's been showing up in just about every press conference, and that's turned over, meaning there's a little less pressure. Powell started talking about that when it was 2-to-1, 2 openings for every unemployed person. I actually reference it in our 2023 outlook that just is released, as we mentioned earlier. And that's turned over. I think quits rates is turned over, meaning the churning is starting to slow a little bit. Now, is it higher than pre-pandemic levels? Absolutely. That's why I want to show this graph going back, several years. It's still much higher than pre-pandemic levels, but it's the direction. I think, Marc, you like to talk about this, that directional change. You said that in a couple market signals and different street views and things like that. I think that's a great reminder. So when people look at what we're saying and look at our graphs here that we're sharing in the broader context, why is the market responding like it is? What's the directional change that matters? You want to go to the next slide. This slides into the housing market, and that is, people have been asking me this, for months now, and just really helpful to think about how different the housing market is, the mortgage market is now relative to a decade ago, and those several years back when anyone was getting a mortgage. Nobody, you didn't even have to put any money down. You're putting zero down and interest only kind of loans. That's much riskier than what we're seeing in this current environment. Nonetheless, look at how high median prices are. Yes, they've come back, but they're still much higher than pre-pandemic. You think about, just look at that gray column, gray shaded areas. That's just the recession. You saw the little COVID recession there in March, April, May of 2020. And then comparing it with the great financial crisis, that's your other gray, much wider shaded area. And you look at median prices have to come down a little bit more, but it's possible to say, look, they really can't come down dramatically because supply is still so low. And that's the dark blue line. Month supply just says, okay, given the sales rate, how fast can inventory be depleted? In roughly 3 months time with the current sales rate, we go through all our inventory. Meaning, this is existing home sales, by the way. New home sales has a little higher supply. But either way, when you think about the demographics of Gen Z and millennials, you think, all right, you combine that with the fact that builders have just been underbuilding for a decade, and that's really crimping supply. So again, going back to our finding balance concept, housing does have a little more to go in terms of trying to find that balance between the demand and supply. Certainly, mortgage rates and the elevated levels of borrowing costs have pulled and slowed down the rate of housing activity.
So, on balance, Dr. Roach, I mean, as investors are checking their personal asset allocation and asking themselves, fundamentally, what is that resting on at this point in time in terms of the current state of economics? How would you make that a assessment? I think we've touched on some of the softish landing aspects of what it appears to be going on, at least so far, and we reserve to change our forecast at any point. But just for the audience, I mean, in summary, how would you characterize the current backdrop of U.S. economic condition?
Yeah, that's great. I think a reminder of just the tale of two economies. It's the upper income, lower income, very different feel, very different outlook, very different spending patterns. But in sum, we know that the domestic economy is largely supported by upper income households. Hence, there's been a lot of savings that cohort had to support spending in the face of very, very high prices. Food, energy, healthcare, a number of those services, airline prices, some goods, of course, have fallen, as we've talked about in earlier slides. But on balance, the economy has been able to kind of withstand these immense headwinds from high inflation because of a fairly decent stock of savings. And as inflation is starting to ease, that's going to help, in essence, allow us to not have a likely scenario of replaying that great financial crisis. So we don't expect the 2008, 2009 kind of scenario where something in the funding and credit markets breaks, and so that impacts the economy in a much greater fashion. We're expecting the economy to contract the first of next year. But at this point, so far, the data looks like the economy is going down to that softish landing. We just think that there might be a chance of sticking that landing by the time we roll into Q1 next year.
Okay. Well said, Dr. Roach, as always. I thank you for your time today and the opportunity to talk to you a little bit about what's going on in the economy. I very much appreciated. Folks, that'll do it for this edition of the Market Signals podcast. It's good to be with you as always. Check in with us next week. Meanwhile, enjoy the rest of the week.